In this video, we are going to compare FAANG stocks and MAMAA stocks. I'm sure all of you already know that they are very similar. It's just Facebook changed its name to Meta platform and Google changed its name to Alphabet, and FAANG stocks has Netflix in it, and MAMAA, let's call it MMA, like mixed martial arts. MMA has Microsoft. Why should we bother learning more with these most valuable companies of the world? Well, because if you are an index ETF fan in Australia, such as NDQ or IOO or VGS, most likely you'll own these stocks: Apple, Microsoft, Amazon, Alphabet, and Meta platform, or Facebook. And I want to share with you what I've learned with this very, very expensive company with market capitalization over trillions of dollars. They may deserve that very high valuation, and the traditional price to earning ratio, PE ratio, is not enough to evaluate an investment. I'm gonna show you with these companies, even though they were trading at PE say in 30, if you invested in this company 5 years ago, you will still yield at least double-digit return annualized per year. So let's start with FAANG stock. We know it's the term that is popularized by Mr. Jim Cramer from Mad Money, CNBC. He thinks he knows everything about everything. And this is the chart of comparison with IVV, the S&P 500 ETF listed in ASX, provided by BlackRock, with Apple, Amazon, Alphabet, and Meta platform, and just to show you how they've performed the past 5 years. You can see S&P 500 from 2017 till 2022 has gone up by about 78% per year, or annualized, it's about 12% per year return. The most amazing stock increase is Apple Incorporated with an increase of 288%. And the worst performer is Facebook by Mark Zuckerberg with negative 17% compared to 2017 level. You can see the big difference of FAANG, and now everyone is focusing more with MMAs, is that MMAs invest in Microsoft, whereas FAANGs invest in Netflix. And for the past 5 years, Microsoft has outperformed Netflix by a lot. It has gone up by about 223%, whereas Netflix has only gone up about 35%. And if you have followed Netflix, looks like they have fallen from heaven after the amazing Squid Game. So what I did is that I compared the market capitalization of these 6 stocks from 2017 and 2022 and add them all up, sum it up. And these 6 companies in 2017, the total market capitalization is only about $2.8 trillion. $2.8 trillion. And in 2022, he has gone up by a lot to about $7.2 trillion in market capitalization. And 3 of them, Amazon, Alphabet, and Microsoft, has been valued of at least $1 trillion company. And you get the annualized market cap average growth from 2.8 trillion to about 7.2. That is about 20% per year growth for that 5-year period. That's a pretty good return. Now let's dig deeper to their financial performance, the revenue and the net profit. So basically, I want to compare the revenue back in 2016 and the revenue reported for the calendar year 2021. So we can see the 5-year trend. How is it possible that the market capitalization, the stock has gone up by 20% per year on average? That must come from the growth of revenue. So let's start with the revenue from Facebook. In 2016, they reported a revenue of 27 billion, and 2021 it has gone up by a lot to 117 billion. Geez, that's a good business. And the net profit has gone up too, from 10 billion in 2016 to about 39 billion in 2021. And yet, the share price has been punished. Because if you look at the annualized revenue and profit growth for the past 5 years, that is at least 30%. The lowest revenue growth comes from Apple, that has grown its revenue from $215 billion. 215, that is more valuable than BHP, to about $365 billion in revenue in 2021. But the net profit has grown a lot more, from $45 billion to $94 billion in 2021. So that is about 15% annualized growth of profit, because they have doubled in 5 years. And I can say this with Apple. Apple is one company where they can squeeze the profit out of the customer, out of you Apple fans, and the Apple fans actually like it. They like to pay this expensive iPhone. They don't want to pay cheaper phone. They'll pay for charger. They pay for everything. The Apple Care. They love it. What's interesting is Netflix. Netflix revenue has grown over 3 times, from 2016 level of 8.8 billion to about 29 billion into 2021. But the net profit, net income has grown by a lot. In 2016, the net profit is only about $188 million. In 2021, the net profit is $5.1 billion. That is 26 times what it used to be 5 years ago. And this is why it's very difficult to value this company, because maybe Netflix back in 2016, they're trying to get as many subscribers as possible. They have to make it cheap. Once the consumer rely on Netflix, it's something like a basic necessity. They will always need it. After work, they need to watch Netflix. And they don't care how much Netflix are charging them. In a way, in 5 years, Netflix has improved its pricing power and its dominance in this streaming business. But let's not forget about YouTube, where Alphabet, Google doesn't spend a lot of money like Netflix does to create content, and still there is so many people trying to create content for YouTube for very, very cheap, including me. Let's not underestimate Amazon and Microsoft Azure cloud service. They are massive and a lot of countries need them. So this is the last slide. Thank you for watching up to this point. What I found is that the market cap growth of these 6 companies, remember, if we total them out and average them, is about 20% per year for that 5-year period. And it's interesting that it matches with the revenue growth of these 6 companies. If you add them all up, from 2016, the total revenue is about $563 billion, and it has grown to about $1.5 trillion of revenue. And if you analyze that, that is about 20% as well. Now, with the price to earning ratio. So what I did, remember we compared the total market cap has grown from these 6 companies from 2.8 trillion to about 7.2 trillion. And that in turn is about 20% per year growth, right? I look further in looking at comparing it with the price to earning ratio. So I add them all up. The net profit after tax for these 6 companies back in 2016 reporting period, all 6 of them reported about $94 billion of net profit. And after 5 years, it has grown to about $321 billion. And we do a comparison. So 2.8 trillion divided by 94 billion, and 7.2 trillion divided by $321 billion. And we get the average PE ratio. And in 2017, we get a PE ratio of 30. And in 2022, we have a PE ratio of 22. And what does that mean? That means the investor who just came in 2016, 17 and just buy all of these 6 companies stock at an average PE ratio about 30, they still make a 20% return for the next 5 years till 2022. That is crazy. Usually you can't get 20% if you buy something at the PE ratio of 30. That's too expensive to most people. Right. And this is what I've learned, and I think PE ratio is not enough because we don't know what this 6 company can reinvest the excess cash flow and how big is that return. It could be 30, 50%. For example, Netflix could make another Squid Game in middle of another continent and they can make 40% return on investment or something crazy like that. And another crazy thing is that if you are an index fund investor, say S&P 500, NASDAQ 100, you don't have to do a thing or even worry about who's going to be a winner because you're going to invest in this winner anyway. That's why VGS, IOO, and IVV and NDQ, NASDAQ 100 invest in Apple, Amazon, Microsoft, Meta platform.